Is revolution in store for the Federal Reserve and US monetary policy? A brand new way of looking at central banking? Imagine a world where your paycheck actually keeps up with the cost of living, where the Federal Reserve doesn't just chase a magic 2% inflation number, but actually fights for you, the hardworking American whose real income has declined for at least 25 years. Well, former World Bank President David Malpass just outlined a radical vision, a Fed that prioritizes growth, lifts real wages, and puts the middle class first. Is this the radical shakeup in monetary policy and central banking that our economy and society need? This will be part one in a two-part series. So let's get into it. This is, I think, critical. Both of these two parts will be really, really important to watch. It appears like we are reshaping institutions. This is common in the fourth turning. If you subscribe to the kind of structural demographic theory by people like Neil Howe and Peter Turchin, the fourth turning becomes a period of crisis and a desire to reshape institutions. And this morning, I heard David Malpass talking with Bloomberg TV about some of these ideas, and I really think we are headed in a totally brand new direction. We've been covering the fiscal dominance, negative real rates that appear to be the direction we're heading in. From the central banking kind of monetary policy academic side, it appears that there are some brand new concepts being floated and a brand new way of looking at central banking and the goals of central banking. What is the Federal Reserve actually supposed to do? But in order to understand the proposals and how it might change, first we have to understand the problem. First, we have to understand what central banking was like during the kind of old regime, right, from say the 60s onward up until recently. And we also have to understand where the average American is relative to things like financial assets. And a lot of this will get into my silent depression sort of thesis. That'll be at the end. So I think it's really important to us first establish some of those key pillars before we dive into the actual proposals and how the direction this might go and how it might all change. So one of the key points here is that during the time of the 70s and 80s and the great inflation, recession, stagflation, double dip recession, high inflation, high rates, well, government debt to GDP had been delevered. It was very low. It was 30 or 35%. And the reason for this, as we covered in the World War II video, is after World War II, the Fed and Treasury act in concert. We were under a fiscal dominance regime where the Fed's goal was not any sort of mandate for stable prices. It was to help the Treasury manage the interest expense, help the government manage the debt. And sure enough, they did. And they kept interest rates were lower than the nominal growth rate. We were able to grow our way out of the debt. Now, we are in a totally different economy today from World War II. So don't think, World War II, we grew our way out, so it's really no big deal. We were the world's factory. We rebuilt Europe and served with our industrial capacity was far beyond anything that we see today. It's a totally different economy. It was not hyper financialized. It was actually net productive. We didn't run a massive current account fiscal deficit. There's a huge number of differences that we will get into all of these things and the kind of silent depression on the side of the middle class American. But the key point here is that we were able to do it and delever so that when the inflation came, the Fed was able to jack up interest rates quite high and not really and have an effect on the actual inflation rate. And the reason for this, the structure of the monetary system was different back then. And we'll get into some slides that show this. Then, of course, from the early 80s, we had falling cost of the debt. And the falling cost of the debt allowed the government to increase debt, right? If the credit card interest rate is only going down, well, it kind of encourages you to take on more and more debt. Well, eventually you get to a point where it all kind of blows up and you're no longer able to service your debt. I would argue we're there or very close to there. And as we could see in 2022, we broke out of this multi-decade downtrend in the cost of the debt. And the problem is that now debt to GDP is 125%, much different from 30%. No economist would ever say 30, 40, 50, even 60 or 70% debt to GDP is a problem. Not a single one. Now, 125% is a much different story. And part of the reason for this is that, again, the structure was different. So, again, remember that private banks create that let's take a step back. The monetary base, which is currency created by the government, treasury and mint, plus bank reserves, which are part of the monetary base. Those are created by the Fed, right? When it engages in quantitative easing and balance sheet expansion, the Fed prints bank reserves, deposits those in an account for a private bank, and in exchange, they're purchasing a treasury bond or a mortgage-backed security. That's the monetary base, and it's about $5 trillion. Well, if you look at the M2 money supply, which is a more broad way of measuring the total dollars in the system, it's already at 22 trillion. But we established the monetary base. There's only 5 and 5.5 trillion of actual, real, fundamental dollars. You're already talking about leverage in the system, of 4x leverage in the system. And of course, M2 is not even the most broad way to measure all the dollars. It doesn't count liquid investments in, say, US equities, for example. Doesn't count dollars that people have in a house. So there, it's not even the most broad way to measure it, and you're already talking about 4x leverage. Most dollars in your checking account were created by a private bank through a debt-based system, right? Where dollars are created by issuing debt. So when you want to go buy a house, the bank writes a mortgage. They just create dollars out of thin air, give those dollars to you. They're very real dollars. You can go then spend them to buy a very real thing like a house. And those are real dollars, but they were created by debt. They are private bank credit creation, and that is how most dollars are actually created in the modern day system. Well, back during the 70s, when there was high inflation and the Fed needed to jack up rates during the Volcker era, this total private bank credit creation was a much larger share of total US dollars. Now, boomers were also coming of age, right? So they were all buying cars, buying houses, competing for wages, driving wage gains higher, right? And so what this caused was inflation. You also had supply shock issues, right, with like the oil embargo and things like that. And the two of them created really a quite dire situation for the Fed and the central bank to control inflation. Well, because of the way that the role that private banks are playing, by raising rates, you discourage private banks to create dollars. You discourage lending in the private bank sector. And so you can control inflation that way. Well, look at what happened in 2008. Total bank loans as a share of official government money, right? Bank reserves plus currency, created either by the Fed or the Treasury, declined massively and has not recovered. So I will take a measurement here from the peak in April of 2008 to where we are today. Total bank loans have declined 71% as a share of this official government money. Now, blue shows total bank loans as a share of GDP. I think it's a less useful way, but it illustrates a similar point, which is since 2008, total bank loans have not been growing. This private dollar creation, this private bank dollar creation has not been growing at the same rate even as GDP. As we can see, this line is lower now than it was going into 2008. What this indicates, GDP and total private credit have been growing. Both of them have been growing, but GDP has been growing faster. Or put another way, private bank credit creation has not been keeping up even with the GDP growth rate. So you see kind of this gaping hole now that private banks are not creating dollars and are not driving liquidity and dollar creation. Someone has to be stepping in. Well, who's stepping in? The government. So the other way to think about this, by the way, this white line, is if you invert it, it shows you the role at which the government money creation has overtaken the private bank credit creation, right? And what we see is that from 2008, government share of kind of dollar creation has just skyrocketed. That's another way to think about it, and we'll see that here in this slide too as well. This slide shows the deficit as a share of GDP and then the unemployment rate. Now, remember the kind of old thinking during the prior era of central banking monetary policy was in a recession, unemployment goes up. You run a large deficit to stimulate your way out of the economy. And then as soon as unemployment comes down, indicating the economy has recovered, you bring your deficit back down. And sure enough, there's a very tight correlation. And that worked. Well, something changed again around 2008, where the deficit as a share of GDP here in January of 2008 was 1%. 1% of GDP. We are now actually at 7%. We're at 0.066% of GDP. So if you round up, we're at 0.07% of GDP. So the deficit has gotten 7 times worse, or has increased 7 times faster than GDP. Unemployment rate, meanwhile, is down. Again, I use U6, and the headline unemployment rate is not the best way to capture the health of the average everyday American. We'll get into some slides that do just that. But unemployment's actually down, and yet the deficit as a share of GDP has increased. So here, let's take a look at government spending as a share of GDP. And again, you can see a very similar trend to the deficit as a share of GDP. The government has been stepping in to a larger and larger degree. Another key difference here is that, remember, back in the early 90s, if we go back to the debt to GDP, back in the 90s, debt to GDP was half of what it is now. It was between 50 and 60%. And that was the last time that interest outlays as a share of GDP were this high. Now, remember, this data I have here for interest outlays is a bit lagged. It's actually worse than this. So nominal interest shows as 880 billion per year. It's actually closer to 1.1 trillion. So it's just lagged a bit. It's actually a little bit worse than this. But interest outlays as a share of GDP have been up here before. The difference, though, is that government debt to GDP was much, much, much lower. It was basically half of what it is today. And in purple, you can see, the nominal interest outlays. And remember, we had decades of falling interest rates. Well, what's happened recently? Again, we've broken out of that long-term, multi-decade downtrend in interest rates and are headed higher. So one of the key principles for what we'll get into in part two is this principle here. So we find ourselves heavily indebted, 125% debt to GDP. We were able to kind of grow our way out of the debt following World War II, and the way we did this was we kept the cost of the debt lower than the nominal growth rate. Put another way, the nominal growth rate, nominal GDP, the growth rate was higher than the interest rate on the debt on average. And by doing that, you decrease the leverage, you deleverage the system. And sure enough, we were able to do that. As we can see, though, when the cost of the debt, using the 10-year yield as a proxy, when the cost of the debt rises above the nominal growth rate, you get an increase in the debt burden. Debt to GDP actually goes up. And remember, as debt to GDP goes up, the marginal productivity of each dollar of debt goes down. Well, in the past 30 years, that's only happened during a recession. Look at what has been happening recently. The 10-year yield is basically at the nominal growth rate, and most likely is going to move higher, especially if the fiscal dominance monetary policy that we've addressed in the past couple of weeks, past couple of months, if that comes to bear, the long end of the yield curve will probably go up. Now, nominal growth will also go up, so we'll have to watch to see. But this basically proves that it is possible to grow your way out of the debt. And what it shows is the key to that is keeping the interest rate, the average cost of the debt, below the rate at which the nominal GDP is growing. So, silent depression, average American. Let's get into some of this. So, I've done videos on this before. I've been talking about this for about 2 years. More and more people are finally kind of waking up to some of these realities, which I'm very thankful for. But let's go through some ways to look at the average hourly wage. So this was the first one that I published that really kind of took off, was this exact chart. So here we're taking the average hourly wage, dividing it by GDP. Now what this shows, again, is if the average hourly wage was growing at the same rate as GDP, that number that is the holy grail that you hear every night on the nightly news and how strong the economy, they always cite GDP and the growth rate, right? This is the aggregate economic output of the US economy. Well, if it's 3%, and the average hourly wage growth is growing at 3% per year, this white line would go straight sideways. What it shows is that GDP, the denominator, has been growing much faster than the average hourly wage. And this chart goes back to the late 60s. Same thing is true for the average hourly wage as a share of M2 money supply. Now, remember, inflation is a monetary phenomenon. Rising costs are just a consequence of monetary inflation. And what we can see is, again, M2 money supply, this is a more broad way of measuring the money supply. M2 money supply has grown much faster than the average hourly wage. And then in yellow is kind of a more tangible way of thinking about this. Here is per hour of average work, how many ounces of gold will you get? Remember, gold doesn't change in value. It is a shiny rock. It's been a shiny rock for thousands of years. That's really all it is. Sure, there's kind of marginal industrial uses around the margin, but in general, it is just a store of value, a measuring stick for monetary inflation, for currency debasement. Well, back here, kind of the peak I generally used for the start of the silent depression in the early 2000s, the average hour of work would get you 0.06 ounces of gold. Well, what is it now? It is 0.01. That is a massive decline in the real purchasing power in gold terms of the average hourly wage. In fact, it's about 80%. So the average hour work gets you 80% less gold. Now remember, gold didn't change in value during this time. It was a shiny rock back here. It's a shiny rock now. All three of these metrics show the same thing, which is the average American's purchasing power, the average American's wages have been falling precipitously. Now we'll go through some more that really paint the picture here. Here's personal interest payments divided by the labor force. So what this tells you is per person per year. What is the average person paying in interest? We can see, and it's a percentage chart. So this is the percentage change in this metric since 1968, around the end of the gold standard. What we can see is personal interest payments per person have grown at 2,200% since the end of the gold standard. Well, the average hourly wage has only grown at 969%. So about, two and a half times faster personal interest payments have grown per person relative to the wage that the average person is getting. So here is, I think, a very interesting way to look at it. This is the personal interest per person, per wage. And what we can see is that it's been up here at these levels before, but the last two times that it was ever this high, again, this is personal interest as a share of the per capita wage, per person wage. We can see that a recession was followed immediately after. Now, am I calling for a recession? No, it's not my base case, but I do think it's quite interesting that the last time we were here, a recession was followed immediately after. Well, look back at the 70s. Look at how low this personal interest as a share of per capita wage. We saw a dramatic rise here in the 80s into the 90s. And there was some degree of kind of deleveraging following the GFC, and this is reflected in household income as a share of household debt as a share of GDP. It's reflected there as well. A lot of it due to housing and the currency debasement led price appreciation of housing for the older generations. For the younger generations, it's a much different story, as we have gone into in our other videos. So here is the inverted current account. Globalization is a key part of this entire story, and it's a key part of Mr. Malpass's kind of outlook and proposal. So I think it's really important to drive this point home. Some of you may have seen this before, but it's very, very important for people to understand this relationship. So here is the inverted current account. And before we go through this, I'm going to just to make this very, very simple, the current account is one of two main accounts for the government, the current account and then the capital account. It describes kind of international capital flows. And here with the current account, what it basically is the balance of trade. There are other components to the current account, but they make up such a small portion. As you can see, the vast majority of it is the balance of trade. So our trade deficit, put another way, it is a mathematical reality that if a country runs a current account deficit, they are running a capital account surplus. I mentioned those two main accounts. Well, they must balance out. Those two main accounts must balance out. So if you run a big trade deficit, a big current account deficit, you must run a large capital account surplus. What this means is that capital is flowing into your country. Currently, at the rate of $450 billion per quarter, that's about, I don't know, $150 billion per month must flow into financial assets in the US as a direct result of our trade deficit. And this has profound consequences on the price of financial assets. Here is the median family home price divided by the median family income. And it basically tracks this capital account surplus. As more money must flow into financial assets in America from the rest of the world, it makes sense that the affordability of housing gets worse. Now, there's a divergence here. This was when the Fed purchased over $1 trillion in mortgage-backed securities, temporarily pumping the median home price despite the trade deficit not doing anything. Eventually, though, that corrected when the Fed engaged in quantitative tightening of those mortgage-backed securities. So this period of time was an anomaly that was easily explained by what the Fed was doing in the central bank policy. Here's the net worth of the top 1% as a share of GDP. Again, quantitative easing. The Fed was massively printing bank reserves and creating dollars out of thin air to buy financial assets like U.S. Treasury bonds and mortgage-backed securities. We can see that in the Fed balance sheet here in red. So this is why, again, it diverged from the trade deficit widening, is because the top 1% benefited massively from QE. This is a critical point to understand as we get into part two. The top 1% benefited massively from quantitative easing through asset inflation. The price of assets, a lot of that QE and dollars flowed into financial assets. And there are some more charts that will illustrate that point that we'll get into. And finally, here's the S&P 500. And again, benefits massively from this capital account surplus. One of the things that foreigners pour their money into is U.S. equities. So the S&P 500, if you own a bunch of financial assets, you love the trade deficit because it means, put another way, a capital account surplus of $150 billion per month that must flow into financial assets. Okay, so here is a percentage chart. So what this is showing is the percentage change since 1990. And it shows the total return of the S&P 500, including dividends, has grown at 5,000%. Now, if you look at the average hourly wage, it has only grown at 233%. That is a massive 20x outperformance over the average hourly wage. The average hourly wage has grown since 1990, but it's only grown at 233%. Meanwhile, if you are wealthy and hold financial assets, your wealth has grown by 5,000%, over 20x larger return in these financial assets. Well, who holds all the financial assets? The top 1%. The top 10% of income earners own 93% of U.S. equities. The average American, the average equity holding is only about $50,000, which is basically nothing. That's not even a year of retirement. Corporate profits have grown about 5 times faster than the average hourly wage. Those have grown at about 1,000%. And the net worth, the net worth of the top 1% has grown right around 1,000% as well. So again, 5x faster than the average hourly wage. I threw GDP in here so that you can see kind of the overall economy. The net worth of the top 1% has grown about twice as fast as the overall economy measured by GDP. The net worth of the top 1% and corporate profits both outpaced GDP by about 2x. Meanwhile, you have the average American who has underperformed GDP, and we saw that in a prior chart as well. So here, we're going to look at 3 metrics, just 3 metrics that I think really illustrate this concept. Here's the net worth of the top 1% divided by GDP. So again, as the white line is going up, the net worth of the top 1% is outpacing GDP. Here's corporate profits divided by GDP. Again, as the red line goes up, corporate profits are growing faster than the overall economy. And then here's the average hourly wage denominated in GDP, divided by GDP. And what we can see is a pretty clear picture here. Going back to the early 90s, the net worth of the top 1% and corporate profits have greatly outpaced GDP. Well, meanwhile, the average American, the average hourly wage in America has underperformed GDP. This is what is part of what is driving the K-shaped economy. The other part is, of course, the current account deficit, or put another way, the capital account surplus. This massive, historic trade deficit is driving wealth inequality, the K-shaped economy, the bifurcated economy. All of this is being pushed by a number of these drivers that we really have to understand before we can get into part two. So just to finish up here, just to really, nail this point home, here is personal income denominated by the M2 money supply. Remember, personal income is exactly what it sounds like. And the M2 money supply, and inflation is a monetary phenomenon. So if your income is growing faster than the money supply, your purchasing power is going up. But what we have seen, going back to China's admission into the World Trade Organization here in 2001, in the early 2000s, as globalism really kind of accelerated, and then, of course, there was the modern central banking era with the Fed and QE, and, of course, that just made it worse. But what we have seen is that the M2 money supply has grown faster than personal income. And so the real purchasing power of the average American's wage has declined for over 25 years. Now, in red is velocity of M2. Velocity describes the degree to the velocity at which monetary units, dollars, are changing hands in the economy. And look at what M2 money velocity has done as well. It's fallen off a cliff as well. This is because the real economy, the real actual productive economy, died in the late 90s, early 2000s. And we have been living in a silent depression. Now, if you're part of the top 1%, arguably the top 10% might be doing okay. You've been doing better than GDP. You're outperforming GDP. You are definitely not in a silent depression. But if you are part of that bottom 50, 60, 70% of income earners, you have been suffering a perpetual, decades-long decline in the purchasing power of your wage. Here is a good way to illustrate the effect of this. This is the S&P 500 divided by the average hourly wage. It shows the number of hours of work at the average job needed to buy one share of the S&P 500 to invest, to invest in the future and try to make money via capitalism and via this capitalist system. Well, back when my parents were, working adults, it was about 15, 16, 17 hours here in the 70s. 15, 16, 17, 18 hours of work. That would get you one share of the S&P 500. Well, now you have to work 200 hours, basically. 190 hours has come in a bit. It was at 200. 190 hours of work at the average job just to buy one share of the S&P 500, one unit of the S&P 500 to participate in that capital account surplus driven by the large trade deficit, to participate in the kind of hyper-financialization of the economy. You have to work 10 times more hours of work at the average job to participate with the same unit. This is just describing one unit of the S&P 500, one share of the S&P 500. It takes 10 times more work at the average job, again, across the entire economy, takes 10 times more work to just buy one share of the S&P 500. This is hyper-financialization. This, the S&P 500 basically determines tax revenue for the government. They're a perfect fit. If you overlay the S&P 500 and tax revenue for the government, it's a perfect fit. We have turned our economy into something where the only thing that is actually holding up GDP is the net worth of the top 1%, corporate profits, and of course, the government and government debt to GDP. As we established back here in one of these charts, where government debt to GDP has been filling in the gap that has been lost or created, the void that has been created as private bank credit creation has basically evaporated and no longer a portion of the economy. So now when the Fed looks to raise rates, it is a much more mixed result because, again, private bank credit creation is not what's driving inflation. The government has stepped in via the massive, unheard of, historic deficit, pro-cyclical deficit. The government has stepped in there, and they have also stepped in terms of on the liquidity side as well. So raising rates like Volcker did in the 70s is a much different story than where we find ourselves today. Also, remember, debt to GDP was one fourth of what it is now, at a very, very healthy range of about 35%. It is now well over 120%. So we find ourselves in a totally different position where central banking and decades of kind of consensus around monetary policy and the way central banking should work are coming under question. And Malpass is one who has talked about this. He talked about this morning. That's what spurred the idea for this video. And in part two, we will dive into some of the proposals that Malpass has and others like him. There are emerging theories and frameworks being developed for this kind of new era of monetary policy, this new central banking approach that I think will be important. So we'll cover that in part two. Stay tuned. I think that this is a really exciting time to live through. You only get to see the radical reshaping of institutions, once in a generation, and it appears that is the direction that we are headed in. So stay tuned for part two, and I will catch you in the next one.